You can start.
Welcome everyone. Good morning, good afternoon and good evening. We're delighted to have a worldwide audience to inaugurate OMFIF's SPI or Sustainable Policy Institute and to do so with Refinitiv as one of its founder members. More on that in a moment. We're also launching today with Refinitiv an important report into the role of data in moving along the sustainability revolution in finance. I'm John Orchard, OMFIF's CEO. Danai Kiran-Kopulu, our chief economist and also the SPI's chair, will introduce our panel session in just a moment. We seek audience participation, so if you do have questions as you hear the panelists talking, please do send them in to us. We're very keen to get those. This is an on-the-record discussion. It's also being broadcast on YouTube as I speak, so do enjoy the session. That we're launching the Sustainable Policy Institute in this way is very fitting, I think. We've done a number of research pieces with Mazars, BNY Mellon and others, and they keep revealing a consistent set of issues which are likely, at least in part, to depend on leadership from the regulatory and official sectors to help fix. And we at OMFIF see it as one of our roles to convene the public and private sectors for grown-up conversations about key challenges facing them both. We've got a fantastic audience today, which is a good example of that. Central banks represented from around the world, as well as multilateral development banks, academics, rating agencies, law firms, commercial banks, and plenty of others. So thank you all again for joining us. I'm sure it'll be a useful discussion. Recent OMFIF research has pointed to data being the next big frontier for designing sustainable policy and investment. This was a key finding of both the Mazars report we published in February of this year about climate risk supervision and the BNY Mellon report we published in July about public investors integrating ESG into their portfolio management. We want to move beyond the well-known data are a problem issue to understanding exactly what the relevant questions are. Our teams at OMFIF and Refinitiv spoke to over 30 policymakers, regulators, academics, and investors over the past few months. And we're pleased to share this report with you today, which presents the highlights of these conversations. We're looking at key issues such as ascertaining which data are in fact available and those which are material, and then of course those that still need to be collected. And then once you do have them, how do you standardize them and present them ready for incorporation into models for decision making? We're very pleased indeed to be presenting this together with Refinitiv, building on our partnership under the Future of Sustainable Data Alliance launched in Davos in January this year. And we look forward to continuing this together via the Sustainable Policy Institute that we're launching today. So thank you again all for listening. Have a wonderful panel, and Danai, over to you. Thank you.
Thank you, John. It's great to be part of this and to introduce the report that we did together with Refinitiv. So I'll go over quickly, firstly, some of the findings of the report, and then we'll move on to a panel discussion with our distinguished speakers today. So just starting with the motivation of the report, as John said, we published some research earlier in the year. One was a survey of 33 central banks. We asked them loads of questions about the supervision measures that they're taking related to climate change. And one of the questions was, what do you see as the biggest challenges in supervision of climate risk? And over 80% of central banks said that the lack of data available to identify and assess climate-related risks was a top concern for them. Then in July, we published some research together with Bank of New York Mellon surveying pension funds, sovereign funds, and central banks on integration of ESG themes in their investment processes. We asked them, what do you see as the barriers to ESG adoption or further integration in asset management? Again, the top concern for them, or the barrier, was insufficient data or information. That was the case for all three types of public investors that we surveyed. And so we wanted, together with Refinitiv, to go a bit deeper into this question of, okay, data the questions around data are problematic in supervision, in regulation, in investment, in reserves management, but what can we actually understand about it, and how can we help regulators and investors to navigate the issue of data? So what we did was get the expert views of several institutions in our OMFIF network, several central banks. You can see here Eurosystem central banks from emerging market countries from around the world, as well as international organizations like the World Bank, the WWF, private banks, as well as academic institutions, all contributed their views to this report. We're very thankful to them for their time and their insights. And looking at the issue of data, we wanted to look at the entire cycle of data collection, use, understanding. Firstly, how do we define what data we need? What is material information for investors, for supervision? Does that change when you're looking at it as a central bank who's setting supervisory policy, or who's looking at monetary policy, or as a central bank that's managing reserves? Does it change if you're looking at it from an investor perspective? So there is a dynamic process of defining and reevaluating, when necessary, materiality. That feeds into these issues of setting up taxonomies, disclosure frameworks to align with what is material for different asset classes, for different jurisdictions. And these two together can help understand the economic risks and the forward-looking trajectory of issues such as climate change and biodiversity, feeding into a whole set of data through corporate disclosure. So asking different corporates to disclose how they manage different climate risks, or what risks they're facing. On the other side, we also have different sources of data, from raw data from technology, data capture, storage, and sharing technologies. Also understanding how these can be made available as public goods, how they can be used. So understanding these new technological capabilities can also be another source of third-party rater scores, as well as raw data. And these two sources together, the disclosures, the raw data, can help then to the next stage of understanding how regulators in the industry can interpret and model these non-financial data for supervision, for investment. So I'll move briefly through some of the issues that have come up in the report. There's more questions than answers, but we'll hope this will set the scene for our discussion in the panel. So the first step is kind of data selection. How do we define what is material information? Investors, regulators, policymakers all want to understand what that is, and there's different approaches to that. You can have a principles-based or a rules-based understanding of it. Do you adjust it to more specific contexts, emerging markets, more specific asset classes, or do you have more harmonization of what may be material information? Who gets to decide that? Is it the regulators? Is it between the investors and the corporates? Do you also look at what matters for the risks that a portfolio has on ESG themes, or just the risks that ESG themes cause on the portfolio? So which way does it work? Should it work both ways? And we have here some quotes from some of the institutions that participated in our research. For example, the Japan Financial Services Agencies, saying that supervisors tend to be conservative, focusing more on minimizing insolvency risk in supervised institutions. We have the Banca d'Italia also saying that it's different when you account both for risks and opportunities, how you understand the purpose of ESG data and scores. So when you understand what data we need to collect, there's different traps to avoid that we've tried to highlight in the report. One may be you don't want to miss the train on setting standards. If you're a regulator, if you act too slowly, maybe the private sector will develop their own standards, and that can lead to fragmentation across different jurisdictions. It can also lead to regulatory arbitrage, where investors may move to jurisdictions that have different standards. There's also the question of misjudging materiality. Does it matter if the financial sector is protected for now, as long as the portfolios are protected from certain risks, whether they cause harm on the ESG themes themselves? That should also be taken into account. And also missing the forest for the trees. I think something that we've learned now in the COVID crisis is that it's not just about climate change. A lot of things are interrelated. Biodiversity, interlinkages between different factors across E, S, and G are becoming very important. And that's something also that needs to be taken into account when defining what constitutes material information in terms of understanding what data we need. So once you know what data are needed, then it's the question of collecting them, of actually making them available. And within that, one route is the disclosures. So getting corporates to disclose data. Central banks are indirectly promoting that. Some are making these disclosures mandatory. The framework that is being followed most widely is the Task Force for Climate-Related Financial Disclosures. Is now being replicated also for a Task Force for Nature-Related Financial Disclosures. That's a newer project, but this is still on a voluntary basis. And some central banks, some regulators are kind of experimenting or thinking about making some of these disclosures mandatory, but there is still some risks there. So a trap to avoid maybe regulatory overburdening. How do you make sure that everyone can take part in this, and some companies that may have fewer resources are not left behind? That leads to the risk of greenwashing. If you try to make everyone come on board, but the standards that you set are very high and there is no support for some of these smaller companies or some of the companies that investors do not invest in a large scale, then how do you bring them on board? There may be some structural blind spots if some of these smaller asset classes or smaller companies are not really part of the bigger investors' radars. So I like this quote from the Bank of England that it is important to supervise firms around climate risk by the information we're expecting them to collate and have available in advance of stress tests. The regulators need to be part of that journey, need to support the institutions when they set requirements for disclosure. What we also found in the research is that disclosures can only get you that far. There is the risks that we mentioned of overburdening. We have so much advanced in different technologies that can help with getting data from different sources directly through technology, rather than expecting the companies to disclose and analyze what risks they're facing. So remote sensors, fixed wing drones, monitoring devices, satellite imagery are all helping understand processes such as deforestation, biodiversity loss, and also on the social side and governance side as well. Having data directly from companies through algorithms can also help create these raw data sets that can be input into models. On the analytics side as well, machine learning, artificial intelligence, cloud computing, these two together, data capture, storage, and analytics, can help make it easier to measure the impact of non-financial risks on portfolios and help also reduce reliance on disclosures. There is also some difficulties with that. If you rely too much on raw data, there can be disruption to the data collection processes. For example, climate change itself may be a hurdle to that. If there's natural disasters that may disrupt the methods or the technologies that you have in place to collect data, there may also be difficulties in terms of some of these technologies may be unsustainable in themselves or harm the environment. That also needs to be taken into account. And also, there may be difficulties when you have gaps in data. How do you fill these gaps? How do you model them? And then finally, once data have been collected, there's also the issue of modeling and using them. So how do you integrate them in models? And that's something that we talked to a lot of the central banks about, that took part in our research. How do you use the macroeconomic models and forecasting tools to analyze the impact of climate change when some of these events are very forward-looking? You also have many binary events, data that are binary that need to be fitted into models that are non-binary. So there is a lot of work to be done also on the modeling side to ensure that that the data are integrated properly. Also, even if you're looking at the same issuer and you can look at the risks that they have in their portfolio, whether they're issuing equities and bonds, the same company may have, you may analyze these data in very different ways. The bond is maturing in a fixed amount of time. The equity has a perpetual nature. So the way that the ESG risks apply to the same company, depending on which asset class you're looking at, will be very different. And that needs to be taken into account in the modeling. Again, when we're talking about use, when we're talking about modeling, there's some difficulty, some things regulators need to be very aware of. Conflicts with other areas of government policy, for example, data privacy laws. How do you have different data privacy laws when you want to facilitate the integration of data in different models? That may create some conflicts. Metadata standards, it's not just about having harmonized rules for how you collect the data, but also how do you use them How do you integrate them in models? Then critical thresholds, especially for climate change, for the E part of ESG. How do you model these and ensure that the models are forward-looking? And also something that came up a lot in our discussions is do not make the perfect the enemy of the good. A lot of supervisors are saying, well, we don't have enough data to be able to proceed with certain climate policies. We need to have time series. We need to see that certain asset classes are, for example, less risky than others. That's also something that is that a lot of them are facing in terms of, we understand that the window of opportunity is short. Climate change, we need to act now. Perhaps there won't be the luxury to have full data before certain decisions that are critical need to be made. So that's also something that is a difficult balance to strike. And finally, again, in data use and modeling, there is the issue of technical skills. So who do you have in your teams to analyze and understand these data? A lot of central banks are and regulators are coming to terms with the fact that you can't just have financial analysts to analyze this data. You need to work with the scientists. You need to build multidisciplinary teams, and also sustainability skills that have been peripheral to financial education up to now are becoming more central. And there are new courses, universities, education capabilities of integrating science with financial and economics education. And that's something that also came up a lot in terms of, do you have bigger skills in your team to analyze these data, or do you make the data more user-friendly for people that are also do not have a scientific background? So there's two routes that one can take: invest more in a kind of analytics side to make the data more user-friendly, or to invest more in the human side and the human resources within the central banks to have people capable of using these data. So that's a short overview of what our report has been about, what we looked to understand, the different life cycle of the data, and what could be some of the solutions. What are the things that policymakers mind when it comes to data and sustainability? I'd now like to move to our panel discussion and introduce our speakers to talk a little bit more about this, and also invite our audience to submit your questions. So I'm very pleased to moderate this session today. We have Nathalie Lefebvre, Director General for Financial Stability and Operations at the Banque de France. Welcome, Nathalie. The Banque de France is also heading the Secretariat of the Central Banks and Supervisors Network for Greening the Financial System. It is a central bank that has declared the intention to run climate stress tests on the banking industry. So we look forward to speaking to you about that. And the governor is also one of the central bankers that has been most vocal about the issue of climate change, and really pleased to have the Banque de France represented here as the central bank leading on this issue. We have Ayla Creevy, Director and Head of the Capital Markets Department at the European Investment Bank, also known as Europe's Climate Bank, Europe's Green Bank. That's very much the vision for the EIB. The EIB, the first institution to issue a green bond back in 2007. So again, a pioneer in scaling up sustainable capital markets. We're pleased to have Ayla with us to talk about that side of things. How do we scale up sustainable capital markets? This will be a key theme also for the Sustainable Policy Institute. And what are the data that we need also across different asset classes? Very pleased to also have with us Sherry Madeira, Chief Industry and Government Affairs Officer at Refinitiv, our partner in producing together this report. Sherry also leads the Future of Sustainable Data Alliance that Refinitiv, along with OMFIF and other partners, have set up to look at the future of sustainable data. So we look forward to having Sherry's views on data for reserves management, for supervision, how central banks can focus on this issue of data and our report together. And also Nick Robbins, Professor in Practice and Sustainable Finance at the London School of Economics, who's been in this area for many years and has recently also published, well, many reports for different central banks as well. There was a chapter in the recent report by the Bank of Spain on central banks and climate change, and now more recently a report about the toolbox of central banks on supervising and investing in sustainable ways. So we look forward to discussing with all of you. Let me start with you, Nathalie. So how give us an update on kind of where the Banque de France is on some of these issues, on how do you see the issue of climate change in supervision, in reserves management, in monetary policy at the broader Eurosystem level, and how do you see also the issue of data? The NGFs that you're part of the Secretariat for is launching a new work stream on data that the IMF and the ECB will be leading. So it is clearly a big a priority for you, but look forward to hearing your thoughts.
Thank you very much. And can you hear me well? Yes. Thank you very much for.
Yes, we can hear you.
Okay. Okay. I hope there won't be too much noise because there are some words outside here. I first would like to thank you for giving the opportunity to participate in this roundtable, and I would like to warmly welcome the OMFIF initiative on sustainable policy. This is a very important topic, and as you mentioned, the role of data in sustainable investment and regulation are very timely. Even though central banks have been pretty much busy to withstand the COVID-19 crisis, we do not lose sight of the longer term, and actually we really continue to work on these climate-related risks. This report underlines the role of central banks and supervisors in sustainability. I fully concur with this idea, and that's why, as you mentioned, we launched the NGFs, the Network for Greening the Financial Sector, at the end of 2017. We were 8 institutions at that time. Now we are more than 70 institutions, so in a very short period of time. And for me, it shows 2 important things. First, climate risks are clearly within central bank's mandate. You were discussing a little bit this issue in the report, but it's very clear. Otherwise, we would not have 70 institutions in the member of the NGFs. Second, in a very short period of time, I think we really moved from an objective of sharing awareness, of sharing best practices, to an objective of action and impact. And that was very quick. And as it is mentioned in this report, climate risk is no longer a peripheral matter for central banks and supervisors. But what I would like to underline, nevertheless, is that, of course, central banks and supervisors can only support public policy, public action, which is key in the transition to a zero carbon economy. And as we like to say sometimes, as regards monetary policy, we can't be the only game in town. And I think it's important because we always speak about central banks and supervisors, but we can't do everything. But having said that, the financial sector is, of course, a key player in the transition to a low carbon economy, because, as you mentioned, climate change is both a source of financial risks, but also of opportunities. And I think it's important to have both views, both legs, because it's not only a question of regulation, it's also a question of business opportunities for the financial sector at large. And the transition, the ecological transition, will need to mobilize all financial institutions. Of course, as central bank and supervisors, our role is first to assess the risks and returns of green projects. And in the end, the question is the issue of the mispricing of climate risks, because the cost of the climate risk are not involved in the current asset prices. And normally the best way to reduce the climate risk mispricing would be to have an appropriate worldwide carbon pricing, but we don't have it. So in the meantime, we think we can really contribute to addressing the mispricing of climate risk by developing a supervisory regulatory risk management toolbox. But I would say that it won't have a full impact as long as we don't have a carbon tax. So the NGFS is doing its part to help building this toolbox, and standard setting bodies have now included these issues in their work program, and we really think that they will leverage on the work done by the NGFS, because the NGFS is a network. It is not a standard setting bodies, but because of its very large membership, it will certainly filter through the standard setting bodies. What do we do currently at the NGFS? First, we were able to deliver according to our work program, and in spite of the COVID-19 crisis. And in particular, I would like to underline what we have recently released, reference scenario analysis, a reference scenario publication, and a guide on how to use this scenario analysis. And we have developed this scenario analysis, these climate scenarios, in partnership with academic research. It provides 8 consistent and comparable scenarios for central bank and supervisors. It was important for us to contribute in that field because we need to have a common tool. Otherwise, each central bank, each supervisor, or even each bank or insurer will have to build up this scenario, and we might have thousands of scenarios. So it was a way to have a common tool. And of course, the issue is, as already discussed, past data is not a good predicator of the future. So we need to use climate scenarios in a way to explore risks and opportunities in different outcomes. And it's the way to have a view on the future and to try to reduce this issue of the tragedy of the horizon. So the guide we have published also provides a lot of practical advice on using scenario analysis. So it's really a way to share the knowledge, to share the best practices. And I would like also to mention that we have released the first report on climate change and monetary policy, which was also a sensitive issue. So it's a kind of initial takeaways, like we have named it, but we already give a lot of insights on the relationship between climate change and monetary policy. At the national level, in the case of the Banque de France and the supervisors, the ACPR, we try to directly implement all what we have contributed in this NGFS report. So we have decided to embark on to simulate these scenarios and to simulate the resilience of French banks and insurers through a pilot phase, a pilot exercise. And we are going to carry out this exercise all over the second half of the year and see the outcome at the beginning of next year. So it's a very promising exercise, but we are still learning by doing. We are still at a very preliminary phase, and we need to remain humble because of all the issues of data, of alignment, of reporting, and so it is a way also to improve all our knowledge. And as you mentioned, the lack of proper data is, of course, key. This is an issue that the NGFS has identified very early, and we really need to improve the situation, to bridge the data gaps, and that's why the NGFS has decided to set up a new work stream to identify what data items are missing and determine how to get them. The work stream, this new work stream has already started its work. It wants to identify the data items which would be needed for the purpose of climate-related risk analysis. Then it would like to try to match the data needs with the available data in order to identify the data gaps. And then thirdly, based on this stock taking and the matching of data needs, try to see which external stakeholders could bridge this gap. So it's ambitious work. We are still at the very beginning, but we thought it would help to provide this analysis. To end my comment, I would like also to underline that, of course, data is not the only challenge to tackle, because once you have data, you need to be able to analyze them and to make them meaningful. And here we really need two very important pieces. First, we need a common vocabulary, a common understanding of the vocabulary. So here it's the issue of taxonomy, and with the EU taxonomy, I think it's a very welcome progress, and now it has to be used and to be deployed. And second, we need standardized reporting in order to aggregate data, because when we will have a disclosure and more data, we need to be able to aggregate this data, and so we need to have more standardized reporting. So we also need to make some progress in that field. And in that journey, because it will be a long journey, we also need to find a path that is proportionate and commensurate to the size of the activities and their degree of carbon emission. We have to embark SMEs in the process, because financial institutions will need to rely on their data, and we have to find a way to make it acceptable for them. And what is complicated is that we need forward-looking data also coming from SMEs. Okay, I stop there. Thank you very much.
Thank you, Natalie. No, excellent points. And I think what you said also about central banks shouldn't be the only game in town when it comes to climate change. I think we've learned that lesson now when it comes to economic policy. Fiscal policy is finally starting to move now with COVID. Hopefully with climate change, we'll see that lesson learned a bit earlier and some more action a bit earlier. But also in terms of the data side, very encouraging that the NGFS is taking it that seriously with a new work stream. And we look forward to working with you on that together also with Refinitiv. Ayla, let me turn to you. So in terms of the perspective of an issuer, can you tell us a little bit about how the issue of data is important to you from that point of view? How do you see it as a barrier? Natalie said it's not just the availability of data, it's also how we understand them. Obviously at the EU level, and you're part of that, we have the initiatives around the taxonomy. How has that journey been seen from your perspective, and what do you think are the important next steps to really scale up sustainable capital markets when it comes to data? Thank you. You are on mute, Ayla.
I'm on mute, yes, sorry, yes, okay. So yes, that was quite a few questions already, so I'll try to remember most of them. But first of all, thank you very much for this invitation. And I think it's this initiative is a very nice one, so congratulations for announcing that, and also for this report, which I think it's excellent, it's very interesting, and indeed, as you said at the beginning, goes beyond the moaning for the lack of data. It's a very analytical approach to the situation. So thank you for that. Obviously, me in my job, I'm EIB on the sort of liability side of the balance sheet, and as you said, green bond and sustainability bond issuer. So we look at it from a slightly different point, but I'll also come to the more generic point for EIB. When we look at the loans, for example, that we allocate our green bonds or sustainability bonds to, we usually have very detailed data, of course, because we are a bilateral lender to our clients, so we get plenty of information from them. We ask all the questions. We have our own sets of questions and data that we fill in. This means that when we have that data available, we are also able to give our green bond investors also a lot of data in aggregated format, and even as project by project. And we have tried to do that, and we have now, especially with the developing of the EU taxonomy, we have been aligning our information and our reporting along the lines of the new EU taxonomy, so that one should have as soon as possible, at least to the parts available, a reporting which is based on common vocabulary. As Natalie said, this is very important as well. So we have been doing a lot on that work on that side, and continue to do so. However, when talking about EIB, there's of course we have the asset side of the balance sheet as well, and on that side, I think we are closer to the situation of other banks, and even where the central banks are, because we are a project financing bank, always have been. So we have looked with a very, very thick comb the projects that we finance, what it does, what it doesn't do, our environmental screening, our social screening, technical screening, financial screening. It has had all of these different filters on it. But when it comes to the counterpart as a whole, we have used a more traditional sort of financial analysis framework like everybody else has. So on that side, I think we are in the same seat, or in the same sort of situation with many other banks, that we are now integrating the analysis of the counterpart as a whole, and it is indeed the question of availability of data, but also the uniformity of data, aggregating it and all of that. That's work ongoing, so unfortunately I can't give you any great sort of recipes for success yet, but obviously we are also not trying to reinvent the wheel in that sense, but to align with what's going on, and also following the NGFs in that respect very close to what is happening on that field. So I think from my point of view, I'm not treating the data myself, obviously, but this common vocabulary that we talk about same things with the same terms is very important, and also that the requirements for reporting are standardized. And this came up very early. I don't know if Nika, you remember when we were at the high-level expert group a few years ago, we had a meeting with banking sector people, and they said their message was crystal clear: we'll report anything you want, just give us a uniform reporting standard and give us a level playing field with each other. And that is absolutely a must, so and very understandable. And we have, of course, based on the taxonomy, there are other things going on around it. For example, the NFRD, which is based on the TCFD framework, but goes a bit further than that, and that is now being revised, and so that reporting can be at least partially based on the taxonomy and the alignment of taxonomy. Now, this may not be yet detailed enough, for example, for the purposes that we spoke about, but I think it definitely should help that we have indeed a common lexicon, and that's what we have been trying to preach, that you don't need to do everything in a similar manner, but let's at least use the same lexicon. And if that is one idea which it's to be adopted, that would be great. And the NGFs that we have been following, obviously involving central banks from all around the world, this is just a very difficult task, because you don't have the same problems, you don't have the same frameworks. So if you take this from the EU level to the global level, the task is getting more complex in multiples. But I think it's an excellent initiative, and I think there has been also progress done already in that field. And just every time one feels a little bit desperate that there's so much to do, if you think about where we were 5 years ago, I mean, we have just come through a huge way from there. I remember being in an OECD roundtable 5 or 6 years ago, and buy-side people there, they were just saying that we don't want to buy because we don't know what is actually green. And back then, the theme of the day was essentially, do not let the perfect be the enemy of the good. And this is exactly what has happened. We are working in parallel in already scaling up the green financial market, be it the bond market, the green loans, the wider sustainability products. But at the same time, we are developing tools on the data side, on the taxonomy side, and even on the regulatory side. So I think we don't have the luxury of time of doing all this in sequences, so we have to move in parallel. Thanks.
Thank you, Ayla. Certainly a lot of momentum on your side and in Europe more broadly, and that's something that came up very much in the report as well. We spoke to central banks, to investors, to academics from all over the world, and I think that the work that the EU is doing on the taxonomy side was definitely recognized as pioneering, and as you said, having that common language, that common lexicon is something that is key in terms of moving forward. Let me turn to you now, Sherry. Your work is very much at the heart of data at Refinitiv. How do you see these issues? We've obviously worked on this report together, and also in terms of the different roles that central banks have as supervisors or reserves managers, as monetary policy, how can we tailor the data that they need? And there is also a question, looking at the questions that are coming from the audience, that fits very much on this in terms of the price stability side, so the monetary policy role of central banks. How can the effects from physical and transition risks, what kind of data and analytical tools are missing and would be needed to help central banks in these tasks?
Great. Thank you, Danae. I'm really excited for this report to be launched. You know, I think that certainly we learned a lot from it, and also the input from across the market was fantastic. Everyone's really willing to share, because if you think about the purpose of this, it's to continue to improve. And in continuing to improve the tools allows us to continue to hopefully channel sustainable investment into the places where we're intending. So, you know, a couple of points to make. You know, I think we need to keep reminding ourselves, you know, what you can measure, you can manage. And so when you measure it, you're going to need to figure out what data points you need in order to be able to create accurate measurements. Obviously, central banks play a critical role in both the supervisory and also the reserves management elements of this. And you know, you asked the question, how can we tailor the data for the usage of central banks and reserves management? I almost feel like, you know, perhaps that's not the right question, because as soon as you start tailoring data or you start channeling it down into specific use cases, you might be missing some of the bigger picture. So perhaps I can pull out a few of the reflections that we've had as a data provider who is in this space off the back of this report. You know, the first point, and I'll pick out 4 very quickly. First point is retrospective data versus forward-looking data. What came out very clearly was the need to make sure that we have both, and that the forward-looking data starts becoming useful in a way that perhaps has been difficult to do so previously, because financial disclosure data by its nature is going to be retroactive in terms of being accurate if you're an issuer. But even if that data is accurate, and often we talk about data quality and data gaps, which I think are really something that we should all be tackling in terms of the entire ecosystem. But even if the data is perfect quality, it may not be useful. So, you know, I reference simple things like right now there is binary data collection. You know, has issuer got A or B? Does it have a policy for X or Y? The level of detail there may not be sufficient. So the answer to the question is absolutely accurate and full quality, but the reality is it's not very useful. So again, we need to start thinking about that retrospective versus the forward looking. You know, alternative data sets, you know, we're seeing this in our business, you know, day by day, practically, it's growing in terms of interest and demand, particularly inspired also by COVID, no longer perhaps being able to have extrapolation from previous data sets be able to be useful. So new data sets are going to be needed in this going forward. So that backwards versus forward. The second thing to think about is that we need to think differently about how data combines to actually make more power. I'll give you an example. So for example, the location of assets. So an issuer can be quite accurate about the location of its assets globally. However, if you're not pairing that with anything else, it just becomes a data point. If we start thinking about the use of some new data techniques coming out, things like geospatial data, the accuracy in terms of from either drones or satellite, et cetera, often this is being used for deforestation and definitely contributes to biodiversity impacts. But the reality is if you actually combine the location of assets with that geospatial data, all of a sudden, then you have something that actually becomes exponentially more meaningful to think about sort of how impacts and future analysis might come to play. So the second point being, need to think about how we combine data sets to become powerful. The third point, and certainly Isla and Natalie and yourself have already referenced it, which is taxonomy. And of course, taxonomy is actually a criteria. It's a definitional based outcome. I'm thinking about it through a data lens. That's my day job. And when you think about it that way, we need to think about what data really underpins it and be quite accurate about that. The concept of a regulatory arbitrage or differences or divergence within taxonomies, I think that's quite a hot topic right now. And when you think about that in terms of the data view, what we wouldn't want is we wouldn't want a proliferation of different ways of analyzing data, different sets of data being demanded in order to be able to meet these obligations. That streamlined nature of how to use data for taxonomy is going to be important. And even taxonomy itself is taking its own paths. When you think about decarbonization as being a central tenet of the EU, Canada and Japan are looking at taxonomies that are transition focused. So again, are there different data sets? Is there a way of harmonizing it to understand what we're really talking about? And then the fourth point is COVID. Obviously, we're all living through this as evidenced by the fact that we are all speaking into a machine as opposed to grabbing a coffee in the margins ourselves today. And if you think about this, I think that this is one of the things that's pushing beyond climate. So it's one of the things that came out of the report, which is this data should also be making sure that it's looking at ES and G. So thinking at the entire impact analysis, looking at sustainable finance, as opposed to focusing only on the climate piece. And of course, if we get the climate piece wrong as a society, we're going to have much societal impact and upheaval. So the two aren't completely separate pillars. But certainly I think COVID is pushing us towards that. We're seeing that as what's going on in the EU, the thinking about the recovery being very closely tied to a green and sustainable recovery. Sustainable in these terms, the way I read it, is not just green. It's also responsible. It's sort of that just transition, that just responsibility and recovery. So I think that that's going to become more and more important to bring data sets into that piece. So as a wrapper, I always look at it from the point of view is, can data in sustainable finance, can we make sure that we focus on three things? Make sure the data is coherent, make sure it's consistent, and making sure it's comprehensive, both within a market, across borders, and across industries. So I think this report's going to give us a lot to work on, and we're looking forward to working on it with everyone.
Thank you, Sherry. Excellent points, and I think great takeaways for our audience as well. And please do download the report. It's available from today. That expands on a lot of these issues and has quotes from the industry and central bank representatives that we spoke to. Certainly look forward to advancing these issues that Sherry just described. Last but not least, turning to you, Nick. So you work closely with Inspire, which is the research network that underpins the work of the NGFS, and you published a report also on the toolbox of central banks, but also what Sherry was talking about just now about it's more about sustainable finance, moving beyond climate. How do you see these issues? How can we build this work of sustainable finance for central banks, and how these issues interact in their toolbox and what they can do?
Well, thanks, Dana, and thanks for inviting me to speak today. I mean, I think this is a really timely launch for your institute, but also this report, because we know that the demand for quality data is vastly outstripping the supply at the moment. So we have a real tension in the marketplace, as we've seen. I mean, I think I will touch a little bit on what we've been learning through Inspire, a research stakeholder of the NGFS and central banks, a little bit on the sustainable capital markets, and then make some reflections, I think, about sort of how we use data, and then look ahead. I think it's been very helpful, the framework you set out and what others have been saying about the need for sort of clear agreed definitions, the disclosure frame, and then also how we use the data. I think one reflection is people are using data around sustainability for often quite different reasons. So there is the classic risk and materiality points, but I think increasingly there is the question about impact and also alignment in terms of, and these, you may need the same piece of data, but you may need slightly different piece of data. In terms of actually the central banks piece, as I mentioned, Inspire produced a toolbox for sustainable crisis response. So essentially how central banks and supervisors, as they are responding to the COVID crisis, how can they incorporate climate factors? We've looked across over 150 different authorities and looked at what they were doing. And I think one of the real lessons which shows why this agenda is so important, whereas in sort of monetary policy, you can actually channel liquidity to SMEs because you know what they are. There are clear categories within your economy and so on. I think it's much less clear, even with the EU taxonomy, about how you might channel to green, or indeed how you might discriminate in terms of carbon performance, either backward looking or forward looking. So I think the crisis, and particularly the use of monetary instruments, has really highlighted the need for this agreement, this convergence, so that calibration can go ahead. I don't think it's a lack of desire to calibrate. I think it's actually this missing step in terms of actually what are the trusted measures so you can distinguish between assets. On the capital markets side, I think, just to build on what Sherry has been saying, I think COVID is leading to the next phase of sustainable finance, particularly on the social dimension. The work we've been doing on just transition has really been propelled forward by the social consequences of the crisis. And I think that has been seen in regard to sovereign issuance, but also issuance from development banks. So again, I would look to potentially sovereign issuance and also the work of sort of real pioneers such as the IB and other development banks as maybe helping to create some of the confidence in the market. These are the front runners. They've helped create markets in the past. I think they can help now on the environmental, climate plus biodiversity, but also the social. Then maybe some reflections on the sort of the data and governance piece. I like the point you made, Dana, in the report that let's not make the perfect the enemy of the good. And I think we need to sort of reflect that perhaps we're not going to be a situation, and anyway, not soon, where we have perfect information. We're going to have pervasive gaps in our data sets. And obviously we should improve, we should work very hard to improve. Perhaps we should be thinking also about how we ensure that financial practitioners and also financial authorities can make decisions, exercise judgment in conditions of pervasive imperfect information. This is going to be a situation that's going to be around for very long, and we can't wait for perfect information. So actually, how do people make decisions? How do people make decisions, particularly maybe using the precautionary principle? You also talked about skills. What I'm hearing certainly is actually as much as a problem around a lack of data is a lack of understanding about how to use data and what it implies. So there's a huge capacity and skills building exercise. And so the human dimension is very important, particularly in developing an emerging economy. So I think that's an area to really focus on, because I think there are a lot of assumptions about what different data points mean. So for example, do greenhouse gas emissions imply financial risks? Not necessarily. So I think that's another area. And then a final consideration perhaps is maybe distinguishing where we do need to have commonality and where we don't. So for example, we do need commonality around definitions. We do need commonality around disclosure. We don't need commonality around analysis. We don't expect every sell-side analyst to come up with the same rating for the same company. And so I think we should not expect that analytics is necessarily going to need the same amount of commonality. In fact, we do want people maybe to come up with different views because they're applying different priorities. So that I think is one area. Sort of focus on where we do need the commonality and also where we don't, and where competition can work. And I think that also speaks to also where some of this data is going to obviously be proprietary and therefore of limited access to people, and somewhere it needs to be public, so clearly disclosure, a public good. And I think there's some interesting work being done, for example, by the World Benchmarking Alliance, also to have public benchmarks available, so that these forms of analytics are not just available to basis. So I think that's an area. And also maybe if we distinguish between what needs to be common and what doesn't, I think that also helps us prioritize some of our actions. So maybe if I can just sort of close, clearly COVID itself is a live and very painful and very brutal stress test. And I think what has already happened clearly in the oil industry is maybe some of the things that analysts were projecting for the latter part of this decade, such as peak oil, have been brought forward by often 8 years, as BP has shown. So I think we are in a moment of acceleration. And I think in this moment of acceleration, being very focused on a few key priorities where we can make progress on data will be very important. So I think some of the areas around monetary policy calibration, areas around sovereign issuance and development bank issuance, questions around actually decision-making, particularly decision-making under uncertainty with imperfect information, and then maybe distinguishing where we need commonality and where we don't. And I think we'll make great progress in the year ahead. Thank you.
Thank you, Nick, and thank you for adding that nuance as well. I think it's easy to say we need a lot of things, but actually boiling it down to where we need to focus more to make the most progress is very important. We have a few minutes left. We have some questions, perhaps one for you, Natalie, that has come in from the audience, is that the NGFS highlights that climate risks are not fully reflected in the markets. But what are the consequences of that for central banks' portfolio exposure to climate risk? So for your reserves management side, you recognize that for the institutions you supervise, but what about your own house? We know the NGFS has published a guide in October under Sabine Mauderer's direction on the reserves management and portfolio guide for sustainable investment. How do you see that contradiction, perhaps? And then there was also another question about the CFTC recently reported that climate change poses a major risk to the stability of the US financial system. Do you think the Fed will adopt financial resilience related to climate change? We don't have anyone from the US here, but perhaps in your conversations at the NGFS, you do have the New York Financial Services Authority as a member. So what is your expectation there? Perhaps these two questions to you, Natalie.
Thank you very much. I try to reply quickly. I think that we try to talk the walk, to walk the talk, sorry, to walk the talk in terms of climate change and how we implement what we recommend in our own activities. But like others, we need to learn by doing. And also we have to take into account the fact that our activity is specific in terms of size, in terms of type of activities. So we have decided, for example, at the Banque de France, to apply responsible investment to our own funds, just to start to develop this process, because as all asset managers experience it, it's a very deep change in our practices. So in our case, it represents around 20 billion euros. So it's not small amount. Huh? And also it is more adapted to this kind of issues because we have some equities in our own funds and corporate bonds. As regards monetary policy, you know that it's a bit more complicated because the vast majority of our portfolios or assets on our balance sheet are either loans to banks or sovereign bonds in the purchasing program. And so it's not so easy to say that we can really move our tools toward a full green approach. So it really requires more analysis. But what we think that we have to undertake this analysis, and at the level of the European Central Bank, it has been decided to incorporate this issue in the strategic review. So I think that central banks now are also moving toward this field of monetary policy, and it is not just in the field of risk management and supervisory. And regarding the US, it's difficult for me to say something. What I can only say is that we have, of course, conversations with our US counterparts. This is also something which has been added in the BCBS, so the Basel Committee work program. And so if it has been added in this work program, it means that the US colleagues had accepted to do it. It is also something which has been included in the FSB work program as regards financial stability. And so I think that our US colleagues are now more open to discuss and to at least develop analysis on this issue.
Great, thanks, Natalie. That's an optimistic note to end on. Hopefully, let's see what comes out of that. But also, thanks for your nuance also on the management of your own portfolios. It's also something that has come as feedback in the other reports that we've done. That is also about the supply of assets, and central banks clearly are very constrained in terms of the liquidity characteristics of the assets they have to invest in. So certainly, a lot needs to be done on that side as well in order to green their own portfolios. But thank you very much, everyone, for joining us today. A great panel. I certainly enjoyed the discussion very much myself. And to all of our audience, you can download the report from today, and we look forward to engaging with you all through the OMFIF Sustainable Policy Institute in coming months. Thank you very much.
Thank you. Bye-bye.
Bye-bye.
Bye.
Thanks.